people, it'd be B. So going through this, salesperson A got angry. Are you kidding me? This is blah, blah, blah. You're nuts. You know, people who are falsely accused of something, anger is a normal emotion. If someone says you did something you didn't, I didn't do. What's the matter with you? You know, that's usually it. Anger is generally a normal emotion for someone who's falsely accused. Now, again, we don't know exactly who took these shoes, but that would be an expected response from somebody who didn't do it. Now, there are some things with B, but and some of you guys answered that B was the most likely one. What things in B's responses would make you somewhat suspicious?
I would say like them accusing a customer.
Yes. One of the things that people who are involved in thefts or frauds or whatever you want to, you know, these kind of things, they do a couple of things. They give you plausible solutions that will explain it away, but they'll also put in vague words like probably, maybe, could have been, because they may have to change their story later. So if someone calls them out on it, they say, well, I said probably, I didn't say it was, you know. So one thing is that they'll have a possible, you know, alternate thing here that they can, you know, point to something else or somebody else, and they'll use vague terminology, probably, maybe, could have been, that sort of thing. One thing was that they didn't know if the boxes were actually put on the floor or not. And yet B seemed to know where they were. I was in front of the store all day. Yeah, they didn't know if the shoes actually were in the store or where in the store they were. And so it seems like, you know, that they do have something there that they know. How about this last one here? This one is also something that you would raise eyebrows a little bit. There's actually two different ones here. Why is, besides, they already have a pair of those shoes? Why would that be suspect a little bit?
They took that extra measure to like basically cover their butt.
Yeah, but well, first of all, this means that they like the shoes, for one thing. They already have a pair. But this thing that is put on the end there, this is another very common tactic that people will use. They'll ask you to explain why they did something. You know, why would I take them? Oftentimes thefts are not, and you know, fraud and that is not rational. It's not rational. You know, you get people that lose $100,000 a year jobs because they did, you know, they stole, you know, whatever, $30 worth of stuff or whatever. So it's not rational. So oftentimes they'll try to have you explain their irrational. Why would I do it? You know, that's one of those things that they always is one of those things that people say who oftentimes are guilty will say, well, why would I do that? You know, why would I murder this person? They were my best friend, you know, things like that. It's the same thing. They're asking you, they're trying to put it on you to explain irrational acts. So, those are all things that are kind of red flags that pop up. Now, we don't have enough information. It may have been salesperson A, maybe salesperson B, or a customer. Who knows? But you know, if you're looking for who would be a suspect in this, salesperson B is probably the most likely one, just because of with you. Now, again, it doesn't necessarily mean that anyone here did do it or didn't do it, but they would be probably the more likely of them. Okay. Now, one of the things that is kind of interesting is what is a characteristic of a fraudster? By the way, fraudster is the coolest word ever. In case you're wondering what the coolest word ever is, it's fraudster. Okay. So what is a characteristic of somebody who's going to commit a fraud? Highly respected? What do you think? Yes or no?
No.
Actually, yes. They usually are. Committed a violent crime in the past?
Yes.
Nope. Violent crimes generally don't fraud. Committed a fraud crime in the past?
Yes.
Yes, it is. Fraud is a weird kind of crime, and the recidivism is very high in it. And that people will commit a fraud, they'll go to jail, they'll do 6 years in jail, they'll get out, they'll get caught doing a fraud within a year. It's one of those weird things that they just keep going for whatever reason, whatever it is. A lot of times they just kick back into that mode. So if someone had committed a fraud in the past, it's very likely that they'll do it again. I forgot, I don't know what the percentage is, like 80 or something like that. Highly religious.
No.
Yes. That's another strange one. Now, it doesn't mean everyone who's highly religious is a criminal. They're not. But one of the, it's not uncommon to have someone who, you know, who went to church or synagogue or whatever, you know, 3 times a week. It's not uncommon. It's actually fairly common that they will be a highly religious person. Now, again, people who are highly religious are not necessarily suspects. It's just one of those weird things that some of them are highly religious. Okay, these two kind of go together, so we'll kind of do the thing. Who's more likely, the young person or the middle-aged person? Do young people usually commit fraud? I'll answer it. No. Middle-aged people, like myself, yes. And this is also unusual. A lot of crime is caused by young people, you know, or committed by young people. As they get older, they don't do it so much. All right, but fraud is different. Middle-aged people are more likely to do it than younger people. Okay, who of these two, a new employee or a long-time employee?
Would it be a long
A
time?
long time employee.
Yep, good. New employees generally don't do fraud. It's the people who've been there a while. Okay. Are they usually friendly or unfriendly?
Friendly.
Extroverts?
Yes.
Yes.
Yep. If someone's a real go-getter, they're more likely. Punctual? Yes. There was kind of a funny one on that, though. There's a really good. Yep, very good. There's a very good documentary I'll tell you about in a second. College educated. Yep. Best employee. Yep. Now, if you want to know who's most likely to commit frauds, say who's your best employee. All right, that's the person. It's a very strange group of characteristics, and when you compare people who commit fraud to the, say, prison population in general, they're very different. They're very different, and they're more along the lines of either college student, advanced college students, or as far as their mentality and all that, and what they are interested in. And more along the lines of college educated, middle-aged people, than they're completely different than the rest of the population, usually in a prison. And their triggers are kind of different too. So anyway, it's a very kind of strange group, and they're hard to identify. People think that they walk around with horns on or something, but they really don't. They'll be the best person in the place. There actually is a there's a documentary. I think people watch it in class. Maybe people do that. There's a documentary called All the Queen's Horses, All the Queen's Pretty Horses, I think it's called. And I don't watch that because it's a really good one. But anyway, it's about this woman who had the fraud so down pat that she actually, it was a small town in Illinois. She was the treasurer and CFO and all that. And she would be gone half the year because she stole all this money, millions and millions of dollars, and she bought horses with it. She was a big horse show person, and she was like one of the biggest in the country. She had dozens and dozens of horses, and if you know anything about horses, they're very expensive. You had to feed them and help, crowd and all that kind of stuff. So anyway, the punctual thing, not all these, my point being, not all these characteristics are necessarily apparent for everybody, but they are, if you take them as a whole, those are usually better indicators. Okay. So anyway, this is our first document. So go ahead and fill that out. You can either do it right on the document itself if you want to. You do it on a piece of paper, or whatever. And then this one you can actually submit today. Nope, not there. Nope, not there. Here. First of all, I'm gonna end this poll. Hey, what happened? Blank screen. Okay, here we go. I'm gonna squish this up. So here you can put that fast fun footwear in, and this is due by next Friday. So way ahead of schedule here, but this will be one of the first thing that will count as the grade for the class. Okay. All right, now the next thing we're going to do is start in on chapter 1. But by the way, we'll take a break at like around 7-ish. We'll do a little bit of the handout here, and then we'll come back and we'll do some sampling. This is the wrong thing. No, it's not. Wait a minute. This is Okay, I see what it is. This is more of the kind of, I forgot, I forgot that I made this last time. This is way better than what I had before. Okay, so let's go through chapter 1. And we're gonna talk a little bit about, this is kind of overview, and it's gonna be a little bit dry and just, it doesn't seem like there's any way of getting around it. But the basic steps for auditing, and this is, we'll get through, through the whole class, is you get a client, and getting a client might sound easy, but it's not, because you have to be able to rely on the client to some extent when you do an audit. And if you think you can't rely on the client, you can't take the audit. And auditing is one of those weird things, you have to pick and choose your clients. And one of the things that they're very cautious of is picking someone of ill repute, of someone who doesn't have integrity, because it does a couple things. First of all, you don't want to associate with those people. And what it does is, if you do take clients like that, it makes the whole profession of auditing weaker, basically. It makes all that are people who are not, don't have integrity problems, it makes them, the audit worth less to them. So one of the things we always try to do is to tell people, look, it's not like McDonald's. McDonald's doesn't matter who you are, you walk in, you say, I want a hamburger, you give them the money, they give you the hamburger. It's not like that. It is interviewing them and getting background on them, seeing if you can trust them enough that you can actually do their audit. So picking a client is actually kind of, it's very involved. Okay, so to get a client, gather evidence, which is a good chunk of this course is going to be based on this gathering evidence kind of thing. And then at the end, you issue an opinion on the client's financial statements. And that's all you do. You issue an opinion, you do not change their financial statements. Auditors cannot change a company's financial statements. Only the company can change them. Now, you can suggest they make changes, and hopefully they will if you don't run into problems. But all we do is issue an opinion, and it's just that, it's an opinion. It's not a statement of fact. It's an opinion. In our opinion, these financial statements are to be relied upon. So it's very different than what a lot of people think. A lot of people think that we go in there and we change the financial statements around and we do stuff with them. If we do find things that are wrong, you go to the client and say, look, you got to fix this. And if the client fixes them, good. If they don't fix them, that's bad, might end up in the report. So it's kind of a different thing that we have here. And we will look at the kind of the opinions that we can give in a second and later on. Okay. Demand for audits. Oh, I mean, a financial statement and audit report. I am not going to go into that one, but it basically the demand for audits is that the financial statements can be relied upon. There also is a demand for audit in that publicly traded companies the auditing speak for that are issuers. We'll talk about that in a minute. Okay. Let's make it a different color. Okay, the demand for audits. Financial statements can be relied upon. If they're not audited, a lot of times people won't trust them. publicly traded companies are required to have them. So if you are a publicly traded company like IBM, you are required to have them. Maybe I should pull that up, audit report for them. Let me see if I have it in here. Nope. All right, I'll pull it up later. Okay, so actually to go through these, you kind of do need to pull it up. Oh, darn it. Give me 1 second. I'll just pull this out. I'll give you guys more of these later on. But I just want to put out a few things here about the audit. As part of the audit, this is one of the more important sentences on here, that we offer reasonable assurance that they are free of material misstatement. So reasonable assurance, material misstatement. Let me put that in over here. So these are very key terms here: reasonable assurance and material misstatements. So do we give absolute assurance? No. And you think about something like Walmart. Okay, for absolute assurance, we'd have to audit every single transaction that Walmart makes. Every single customer that walks through the door, we have to audit their transaction. It would be unbelievably expensive, and it would be basically, I would say, impossible. There's not an auditor in the world that could do that. So we don't give absolute assurance, we give reasonable assurance. We do it on a test basis. We go in there, we test and see if, and you can get pretty accurate. You can get within, say, 99%, the 99% level fairly quickly, testing accounts. So you don't really need to do 100% to get a very tight audit that says, okay, we're 99% sure that this is not misstated. So we don't give absolute assurance. Absolute assurance would mean that we went through every single document that, every single transaction that Walmart made, we went through and checked. We don't do that. Also, materiality. Materiality is, we only look for those misstatements that are material, that someone would pay attention to. So, for example, is $5 million material? If there's a $5 million error, is it material? It depends
Yes.
on what. It could be. It depends on what, though. Let me phrase it different. Is a $5 million misstatement for Walmart, is that material? It probably wouldn't even be listed. They probably list their financial statements in, either millions or maybe even billions of dollars. So a $5 million error would definitely not be material for Walmart. Now, when we're doing audits, what does that tell you? We don't look for small errors like $5 million. Now, for some companies, it'd be a smaller company, $5 million could be huge. I mean, that could be massive. But and then there are rules of thumb that we'll come up with later that kind of show, how we kind of gauge those things. But we only look for things that are materially misstated. So we never say that these financial statements are accurate or correct, because we don't look for that. We look at what's reasonable. And $5 million one way or another on their financial statements. I think they list them in $10 million increments or something like that. It's not gonna make any difference to people reading those financial statements. Now, is $5 million material to an individual? Yeah. But this also is a gap between what people expect from auditors and what we actually do. If you talk to some people in companies, something like over half the people in a company think that auditors look for people embezzling money and things like that. We generally don't unless it's material. So if there's somebody stealing, $50,000 a year from Walmart, the auditors are not going to catch it. They're not going to look for it. That's up to the company to hire internal auditors to go look for those things. But external auditors do not look for all of those things because they're not material. And if they did, it'd probably cost more than $50,000 a year to find someone embezzling $50,000 a year, and it'd be a bad business decision to do it. Okay. Let's see here. Okay. All right. So what do we provide to the financial statements? We don't say they're accurate. That's not very. I don't know if you guys can even see that. And we don't give absolute assurance. So what do we give to the financial statements? We're stuck between B and C. What do we do? Which one of those do we actually give? Yep, very good. Credibility. We give credibility to the financial statements. Hey, you can rely on these financial statements. Are they perfect? Don't know. Maybe not. But they are you can rely on them. You give reasonable assurance that they are free of material misstatements. It's a high level of assurance, but again, it's not 100%, and we're only looking for things that are material. They could be out by immaterial amounts, and we don't look for them. So that's the only thing we give to financial credibility. One thing also I should have mentioned is that the CPA firm is independent from the company. So the auditors, whoever audits IBM, is separate from IBM. They're independent. It's not somebody inside IBM auditing IBM. Now, people inside working at IBM know more about IBM than the external auditors, but they're not independent. So it has to be independent auditors that actually look at the financial statements and then issue an opinion. And that's where the credibility comes in. Somebody outside has actually looked at this. Okay. Business risk. Business risk is the risk that a business will go bankrupt. Okay, information risk. The risk that an undetected material misstatement here on the financial statements. Okay, so information risk is the risk that an undetected material misstatement will appear on the financial statements. So undetected, we didn't know about it. If we knew about it, then it's not a problem. We can put it in the audit report. But an undetected material misstatement will appear on the financial statements. Okay, so auditors are most concerned with which type of risk, do you think?
Information risks.
Yep. Right. We're worried about information risk. You know, we're not responsible for IBM to be profitable. Right? We are responsible for making sure their financial statements that are, you know, if we say they're free of material misstatement, they really are free of material misstatement. If there's a material misstatement appears on it, then we have failed. So we're more looking at the information risk. We're not necessarily there to make sure that they are profitable or anything like that. That's the company's business. Ours is simply to say, are these financial statements, can they be relied upon? Okay. And some of this stuff you guys have probably already know. Corporate governance. By the way, corporate governance, this is a very key term. This is what they, whenever they say corporate governance, they're talking about these two people, these two groups of people usually. The board of directors and the audit committee. Okay. Oops. Okay, board of directors guys coming as far as overall strategies and direction, and that they are generally not the day-to-day people. They could have some of those people on the board, but the board of directors themselves are usually more they don't do the daily stuff. They kind of direct the people who will run the company and, you know, insert people who are the president and all that kind of stuff. And they will overall direct the company as far as what direction that they're going, the policies and plans and all that kind of stuff. They don't actually do the work themselves. They usually are guiding the company. The board of directors. I should say will usually have. Internal directors are people that work for the company. External directors don't. So it is possible that you work for the company. A lot of times say the president is also a member of the board of directors. They work for the company, but they're also on the board of directors. It's not uncommon. But they also, you will generally have external directors, people who do not work for the company, who offer guidance to the company. Audit committee. Oops. The audit committee is a subset of the board of directors. Oops. Yeah, the audit committee. The audit committee consists of only external directors, so you cannot have an internal director on the audit committee. The audit committee. Is responsible for hiring a CPA firm, certified public accounting firm. It's up a little bit. So only external directors are on the audit committee. They can't be internal. The internal directors could very well be the people that make up the financial statements. So they are not on the audit committee. The audit committee is responsible for hiring a certified public accountants to audit their financial statements. One more thing for publicly traded companies. Okay. So there must break this off. There must be at least one financial expert on the audit committee. This is for issuers, publicly traded companies. So IBM has to have an audit committee. They have to have at least one financial expert. As odd as it may sound, a lot of people on the board of directors, it's not unusual for them to not be from the finance area and accounting area and things like that. A lot of times they could be anybody. Sometimes they have religious people. Sometimes they have, there's all different kind of groups of people that they can have on the board of directors, and it's kind of there to, again, guide the company through the big kind of picture stuff. They don't do daily operations, but they say, okay, we should start doing this, this would be a good idea. But on the audit committee, there must be at least one person who's a financial expert. They don't have to be a CPA, but they have to be somebody who knows how to prepare financial statements and things like that. Because you don't want to have is people that have no idea what the financial statements are supposed to look like on that committee who are overseeing that may not be aware of some of the problems that can come up. So anyway, there has to be at least one financial expert on that. Again, they don't have to be a CPA, but they can be, somebody who knows how to make the financial statements. Okay, people do. You know what? I'm going to stop here. So we'll stop here. We'll pick this up on this handout next week, and when we come back, I think we'll work on the. sorry. We'll go to classical samplings next. So let's say let's be back. Let's take a break. We'll say be back at like a 10-minute break. Let's say 7:07. Okay, so for this other handout, don't delete it or anything. We'll finish it. Well, I don't know if we'll finish it next week, but we'll finish it at a later date. So let's get rid of that. I'm gonna go ahead and save this, and then we'll pick up next time. You know, a lot of times what I find anyway, sometimes going through this kind of definition-y stuff is a little it's hard to do sometimes. So all right, so let's go ahead and take a break and be back at 7. Well, change that 7:08. Okay. I'll see you guys in about 10 minutes. Okay, so now we're gonna start with the first handout for sampling, it's called classical sampling. Sampling is when you take a small group and you test it, and then whatever results you get, you project that over the population as a whole. And this isn't just for auditing, but if you're trying to make a medicine, you make a new cold medicine, you test it in a small group, and then you project it over the population as a whole. You don't get all 8 billion people on Earth to take this medicine. You give it to a small group, and then you project it over the large group. We do the same thing. We take a small group, a sample of accounts, whatever they are, transactions, and we sample those and project it over population as a whole. And the nice thing about sampling is, oftentimes you can get very accurate with testing a fairly small number of things. So that's one of the reasons why they do sampling rather than testing every transaction. And for some things, testing every transaction, every item is just not possible. For instance, that an inventory at year end of Walmart would be absolutely impossible. There's not enough auditors in the world that could go to all the stores and have a count of inventory on December 31st or whenever their year end is. So we do sampling, because we can be more efficient, but also it's the only way for some things. Okay. And you guys may have had sampling. I don't know if you guys already had your statistics class or not, but okay, so we do classical sampling, and we have all these accounts. And there are what, 30 accounts. And we are going to take a sample of these and try to project what the overall population really is here. Okay, so we're going to take a sample. Using the first two columns, we're going to take 5 of the accounts receivable for testing. Okay, and now this is important. These, remember, only go up to 30. So we're going to take a random sample. Now, I'm going to take a random sample because a random sample generally is free of bias. That if you take a random sample, a truly random sample, that is not going to have any of the biases that can happen if you say just picked out accounts. If you went through and picked out accounts, you might have bias for whatever reason. So we want it to be the most accurate as far as the population as a whole. We want a random sample. There's a problem though. And the problem is, in auditing, everything must be able to be replicated, must be able to be done again and get the same result. So if I pick a random sample and someone else picks a different random sample, it could very well come up with a different result. So, the question is, how do we pick a random sample that is redoable? It'll be the same random sample that whenever somebody picks it, they should come with the same result. Now, just because they come with the same result doesn't mean that the judgment is the same. If we find out that an account is off by $5,000, one person might think that is material, one other person might think it isn't. But we should both come up with the $5,000. That it's off by 5,000. The judgment part of it is not decided in the sample itself. And one thing I'm gonna stress as we go through this is that judgment is all of auditing is judgment. And what's material, what's reasonable, all that kind of stuff. Those are judgment calls. And which is one reason why it's hard to teach sometimes. It's hard to learn. Okay, so what we have is a random number table. So this is our random number table. We're going to use the first two columns to pick our random sample. Now, it only goes up to 30. That's 30 items. So let's look at our random table here. The first one is 03. So do we have a number 3 in our sample? It's a yes, no question. Do we have a number 3?
Yes.
Yes. So we're gonna pick, so this is our first item we're picking. Okay, we go down to our thing here. Okay, there is no 46. There is no 51. There is no 32. 11. We do have an 11. Maybe I'll make these different. I'll make these green. Okay, so here's our first one. Here's our second one. 14, we can use that one. $18, we can use that one. We have 5. Nope, got 4. 28. Okay, so let me sure 1, 2, 3, 4, 5. Okay, so we picked our 5 items. Now notice that anyone following these instructions will pick the same items, and they should come up with the same result, basically, that we had. Okay, so let's take a look here. I think I got this up. We can just copy these in. So here's our sample. Hey, look at that. There's number 1. Here's our second item in our sample. Okay, so what we're going to do is find out our average for each of these. So we're going to find out the average for the book amount, average for the audit amount. I think I'm going to cheat. I'm going to copy this into an Excel and see if it'll work. Hopefully it does. Do you work? Hey, it does. Okay, so 33,795. Oops. $33,795. $32,395. And then we're going to divide those by 5. And so this will be our average. You know, I can do that over here. Six, seven, five. That's a transposition here, by the way. And this one was 6479. You know, I checked those just to make sure I did them right. But anyway, these are the audit averages for it. So the book average is 6759. And the audit average is 64. So we've been through there, and again, you know, some of these are off, some of them aren't. You know, for instance, the first one, they were the same, second one, they were the same, third one, we got $500 difference. This one, there was a what, $1,000 difference? These two are the same. So anyway, it is an audit. You know, this is just the items that we picked, and again, it's repeatable. Someone else can come in and pick these same ones, and they should come up with these same averages. Okay. Now, for save this here just a second. So we have our averages. So now here's what we're going to do. We're going to take these averages and project them over the population as a whole. So we take this small group, we took 5 items out of the 30. We're going to take those items and we're going to figure out how to project those results for those over the entire population that they have. And there's 3 ways that we do it. Okay. Mean per unit. Now notice that mean is really just average. So the average per unit. Now we have a book average and an audit average. So this is what the company told us that those are worth. When we went out and looked at them, we found out this is what they were worth. Which average is more persuasive? Which average do you think is the better of the two? What the company gave us or what we came up with by looking at them ourselves? The book one or the audit one? Yep, very good. The audit. And you'll find this is true throughout all of auditing. Those things that you find yourself are more persuasive, are better evidence than somebody telling you something. And, you know, a lot of times they may be telling you something, it may be a blatant lie, it may be what they think it is. You know, a lot of times people will tell you stuff, you know, and you find out it's not true, and you ask them about it, and they say, "Really? I didn't know we did that." You know, so anyway, it's always better. It's better evidence. The stuff that you come up with yourself is more persuasive. It's the stuff that you've calculated, your calculations. You have control over them. It's more persuasive than something someone tells you or someone else's calculations. Okay, so here's kind of the formula that we use down here. The audit average is Let me get rid of this. So the audit average is 64.79. And so here's what this mean per unit estimation. This is what this what we're really saying with it. They say, look, we came up with this for our average. We think everything in your population should have this same average that we came up with. Okay, so how many items are there in the population? I think there's 30, right? Yeah, 30. So we're saying, okay, all 30 of these things should have the same amount, right? Okay, so 30 times. Hey, where's my calculator? Oh, wait, I can do here. Nope. Maybe not. Hey, I better label these. So this is the audit, and this is the book. Okay, so 30 times that is some number. $194,370. Kick back and make sure I got that right. 194,370. Okay. Okay, so up here we have the total book value. What they have is 200,000. So their book value that they have on their books is 200,000. Our projected value is 194,370. So the projected misstatement is the difference between those two. $5,630. Okay, so coming up here, let's start filling these in. Using the mean per unit. The projected value is this. The projected misstatement is this. Okay, now here's the tricky part. So we have a projected value of 194. The company is saying that they're accounts receivable. Yeah, accounts receivable. So the company saying their accounts receivable is valued at 200,000. We're saying it's valued at 194,370, and there's a misstatement of 5,630. So are their books overstated or understated?
They overstated.
Yep, good. Usually people miss this on the first one. But yes, they're overstated. They are we're saying they're only worth 194,370. They're saying they're worth 200,000, so they're overstating them by 5630. Now, is that material? That's a judgment call. Someone might say it's material, some people might say it's not, but we should all get the same number there. Yep, good. And and by the way, on the CPA exam, they generally don't test you on things like materiality. They won't say, is this material or not? unless they give you the numbers that you're supposed to calculate as far as what materiality is, they're not gonna say is this material, because that's a judgment call. And it could, two different people, totally sane, experienced auditors, one might say it is material, one might say it is. But we should all get the same 5,000, whatever it was, 5,630 for the projected misstatement. And that it's overstated. Okay. Ratio estimation. Ratio estimation is that things are going to be misstated as a ratio of the total. What this means is that big things will generally have bigger errors than smaller things. Small things, small errors, big things, big errors. So ratio estimation is, says that there is a relationship between how big it is and how big the error is. And we do a projected value. We take the audit divided by the book. And if you're taking the CPA exam and you forget which goes on top, which goes on the bottom, they're alphabetical. Actually, it's weird in accounting. There's a lot of things that are like that. They're almost all alphabetical. Almost all the ratios are alphabetical. If you're in doubt about which is the numerator and which is the denominator, just remember that. They're alphabetical. Okay, so we're going to take the audit average. Divided by the book average. Times the total book value. So we're saying everything's off by a ratio. And so this will be the projected value. I didn't round off the nearest dollar, I guess. Okay, I got 191,007. I'm gonna round off the nearest dollar, 715. $715. Did you guys get that? Are you not saying anything being polite? Oh man. All right. You guys get that? No?
I got 190,699.
Okay. Let's see here.
Interesting.
Did you round off any of this? If you took
No.
No?
Well, I mean, I rounded it had like some change on it, so I just rounded that off. But that's weird. I just did it on my phone, so.
Oh, okay. Yeah. I don't know. Okay, well, that's pretty close. It's probably something with the rounding, something. All right. So anyway, so this is this projected value. So this is what we think it is based on the ratio estimation. So this would be same as before, 200,000. Projected value. I'm going to put this one in. It could be off a little bit because of rounding too. Yeah, it's really close to that. 85. Okay, now this one, so let's see, we have, let's put dollar sign. Oops.
Okay.
Okay, overstated or understated?
Overstated?
Yep. Yeah, again, hold on a second. They have 200,000 on their books. When we do our testing, we say, okay, wait a minute, for our using ratio estimation, that it's off by 191,000. And so we're saying that it's too high, so it's overstated. And again, this is a judgment call if this is material or not. Okay, difference estimation. Difference estimation is kind of wacky. And difference estimation, I did auditing I did internal auditing for about 3 years. I worked at Navistar, they make trucks. And I also worked at US Steel, which I guess they make steel. And that I don't think I ever used difference estimation. And this is why. Difference estimation says that every item will be off by about the same amount. Things that are off will be off by the same amount, no matter what size they are. So if you have a $50 order and it's off, it'll be off by the same amount as a $50,000 order. And it could come up that there's some kind of a cost that's left off, a handling cost or something like that, that is the same for every order, that sometimes gets missed or something like that. And so it is possible that it happens, but I don't think I ever actually used this method. I use the other ones, but yeah. So this one says that it's kind of different than the ratio one. Ratio says little things off by little amounts, big things off by big amounts. This one says everything's off by the same, same dollar amount. So it's a little bit of I would say a less likely scenario, but certainly a possibility. Okay. So what we do is take the audit average minus the book. I'm going to copy these down here. Okay. So audit average. Weird's happening here. Maybe I'm in the wrong cell here. Who made this stupid thing anyway? Okay, so audit average minus the book. Oh, you know what? I think I'm up too high. And it's like sizes. Oh, no, why is this one so big compared to this one? Oh, this one's only 11. I get it. Okay, so if we subtract those, and we'll get a difference. Now, this first one is the audit, so this is the audit over the book. So the audit is this, the book is that, so this is gonna be so we're saying that these are all gonna be overstated by the same amount. 64. 280. Was that a yawn of excitement? I bet it was. All right. So here's what we're saying. All of these are off by 280. That you have to take off 280 off of each of these items. That everyone is off by the same amount. It's all off by 280. So all 30 items are off by 280. So 8,400. And this one is a little bit strange in that we get the projected misstatement first. Right. So we get a projected misstatement first, and we have to back into the projected value. Now, again, you can put a negative in here if you wanted, saying that they have to knock it down by 8,400. But this 8,400, is it an understatement or an overstatement?
It's an understatement. Sorry, overstatement.
Right, overstatement. Very good. Yeah, they actually have everything. Everything is overstated by 280. You know how you work out the minuses and all that. I don't know, but they basically, if the audit is lower than the book, this can be overstated. If the audit is higher than the book, it'll be understated. So the projected value. So we're saying that this is overstated. So the projected value is going to be less than 200,000. So what's the projected value going to be? I should be able to do this in my head. Uh, 191,600. And the projected misstatement will be the 8,400. And so, yeah, so this will be the estimate based on this one. And again, this one I think is probably of the three, maybe the one that's maybe the least likely to be used in most situations. Because it's saying that everything's off by the same amount. You know, a big account's off by 280, a small account's off by 280. And unless you have kind of a special circumstance that probably isn't the way most accounts work. Okay. True or false? All three classical sampling methods will estimate the same projected value for the population. Did we get the same number for all of them? Nope.
False.
Actually, it'd be great if it was true, because then we just have to show you one method. But yeah, it's false. So the different, and we'll talk about later on about what when we use them, you know, which ones we use. But the three different methods that we have for projecting it over. Let's go ahead and do this one. You know what? I tell you what. Why don't you try doing this one on your own? And next class we'll go over it. So see if you can do number 2 on your own. You know, and again, this is, you know, these are some of the first time you kind of seen this, most likely. Yeah, that you've seen a random number table. You may have seen it in your statistics class, but yeah, so see if you can figure out number 2. And I think we'll go over it next class. We'll go over it at the beginning of next class. Or maybe not the beginning, but maybe we'll go a little later in the class and look at it. But so see if you can do this one on your own. I'll tell you what, I'm gonna assign that as we'll have that as homework. So for next week, do this. See, you can do this one on your own. They have 10 items, but they've already got them totaled for you, so it shouldn't be too hard to get the averages. And then see if you can figure out, you know, how we project those over the population as a whole. And hopefully you didn't mess up your spacing like I just did. Okay. So the one thing that we can put in for today, put that fast and fun footwear, what I call it. Fast fun footwear. So go ahead and put that one in. You can put that in, and then put in the and then do this problem for your for next week. I think I'll put the answer up at the beginning of the class, and then we can go over it. Any questions?
Do you just want us to do number 2, or do you want us to finish the rest of this worksheet?
Just do number 2. We'll do some of the other.
Okay.
The other ones, 3 through 5, are more similar to what you'll see on the CPA exam.
Okay.
So and we'll kind of go over those. Again, the author of this book that we have is very good. That his stuff is very similar to what is on the CPA exam. Some of these auditing books, they have wacky ways of showing the statistics. Not this guy. It's almost identical to what you'll see on the CPA exam. So it's just really good in that sense, and that this is kind of the questions and stuff how you're going to see them. So yeah, so just do problem number 2. Problem number 2. See if you can figure that one out, and you know, we'll split it up. And by the way, this is called classical sampling because this is the kind of sampling that you could use for almost anything. If you wanted to know the average, you know, how much does the average duck weigh? You know, you could go out on a pond and scoop up, you know, 10 ducks and weigh them and project how much the you know, the total population of the ducks weigh. You know, these are things that you could actually do with other things other than simply auditing. We're going to find out there is another method that is only for auditing, but we have to do it. Any questions? Okay, and we'll hopefully at least come close to finishing the chapter 1 handout next week. We'll see how far we get, but and then we'll continue working on the sampling. Okay, you guys had enough? All right, I will see you guys in a week's time. Good evening.
Thank you, sir. Have a
Thank
good
you.
evening.
Thank you, Professor.
Have a good one.
Well, you too.